Hi, I'm Natasha Rawlings, an investment manager at Uniseed, and today I'm going to talk to you about early stage company evaluation. Thanks very much to Wholesale Investor for having me along. So I'm going to share my screen. I think you'll be able to see a little bit of me on the screen. And this is really to help you make quick work of a complex puzzle. As always, all of the views today are my own. Okay, so a little bit about Uniseed, the fund I work for. We were created by universities for universities to get some of the great IP that is developed in this country out of labs and into the world where it can make a positive difference. We've been going for 22 years, have had lots and lots of startups and also some really good successes. Our research partners are the 4 biggest universities in Australia and the CSIRO. We were created 22 years ago, which also makes us one of the longest standing funds. And we basically invest in deep technology, which is lab-based tech or hard tech, which is really coming into its own now because of obviously the climate crisis and also COVID-19. So some people say that 2021 for deep tech is like 1995 for digital. A little bit about me now. I'm an investment manager at Uniseed. I'm a startup board member. And before that, I had an extensive career in direct response marketing. I was the marketing director both here and at big global companies overseas. I was also a tech founder and CEO of my own business for a few years, and then I worked for other people's startups, mainly in the SaaS space. I've also mentored at lots and lots of incubators, mainly Sydney University's Incubate, and that's where I get to see a broad representation of the markets. So I'm looking at valuation of all types of companies all the time. So why is valuation so important? It obviously decides how much everyone owns of a company and therefore also predicts a little bit potential future earnings, which is what investors are investing for in the first place, to make a return on investment. It's usual to talk about post-money valuation. That is the valuation after money's been put into a company at its pre-money valuation. So 2 terms there if you haven't heard of them before. And when we're evaluating a company, we're really looking at, are future revenues likely to be high enough to give us the return that we're after? And if not, there's likely no deal. So, and also if the valuation isn't right to begin with, it's probably and agreed upon by first parties, it's best to walk away. So an example of that was when I had my own startup, I had a really fantastic angel investor sort of shadow me for a month, come out and talk to customers, do all of that sort of thing. And then he said, oh, right at the end of that, what do you think your valuation is? And I told him, and he said, oh, we're so far apart, we might as well stop talking now. And I think that was a really good lesson for me as an investor. I really hate working people's time. So I try and get that out early. And if we're too far apart, I let people know why, and then it's better just to part ways and let them get on and talk to the next investor. And I think if an investor and a company are keen to do a deal, they've got to work really hard to find a valuation that works for both of them. So how much are the founders going to be diluted? If you're going to dilute them too much in this raise, there's a risk of a future recap by other investors anyway to keep incentivizing the founders. So it's something to keep in mind. You as an investor have got to look at, can you make a target, your targeted return? In the case of my fund, it's 10 times because we invest at the really early pre-revenue stage. And also how much competitive pressure is there. If there's a lot, you might not have time to do a lot of diligence around the price, but you might rely on, other investors who know more about this space to help lead you a little bit there, and they should share their diligence with you. Money really should align all of the parties for the best outcome, which is obviously business growth. What happens when valuations go wrong? I've seen this firsthand, so I can tell you about it. A down round can close a company. So if it's too high in that first round and not enough milestones and goals are kicked, I think a lot of people would rather see a company go down than have a bruised ego. So, especially when you want all of the shareholders to sign off on the raise and the documentation, it can get tricky. Also, a misalignment can lead to bad behaviours. Founders become disincentivized, disillusioned, and also I've seen investors become sort of gangster-like, a little bit bullying to get what they want further down the line to make it worth their while. So, keep those things in mind. And also, if the valuation is too high, me as an investment manager, I've got to get it past my investment committee, past the board, past other investors. So it's got to be a price that seems reasonable to all. Okay, so why is this whole area so hard? Why is it so hard? Well, the main thing is that the usual financial models can't be applied that you can for later stage companies. There's usually no revenue or nothing that looks particularly repeatable. So there's no point doing multiples of revenue or EBITDA. They'll probably come to nothing anyway. Discounted cash flow may be useful, but everyone's got to realise it's a complete fantasy early on. However, a lot of investors I know do it because if it doesn't work on paper, how on earth is it going to work anyway, right? So I think that's worth doing. Okay, I'm going to put this on sleep. A lot of analysis to begin with is actually quite qualitative. It's looking at the people, the product, the market opportunity, and the business plan. And a bit of human, gut feel comes into that. But I do think that most of the time that's our, human brain computer working and just looking at comparables in the market and what we've seen before to really, come up at that right price. And I'm going to show you a few ways today that I do it, and I've seen other investors do it, that might help you when you're evaluating an early stage business. So I'm going to look at a few different ways. The comparables way, that's obviously looking at like companies. The complex way, which is what I do here at Uniseed, and a combination of really. The club way, the Catchall Ways, which is just everything else. And I'm not going to talk about the convertible note way because that's when you're putting valuation off to a future point in time. So a hint is that, good founders should already have done work on this, and that will give you a good place to start and talk about, where that company sees themselves with other investors. So, look out for that when you're talking to to founders. So I'm going to start off with the comparables way. So comparing it to other companies at a similar stage. So you can look at private companies. You can look at revenue multiples in class. So for example, digital health, what do those companies usually achieve as a multiple of sales perhaps, or just as a general valuation at that pre-seed or seed stage? It's great if you can get access to PitchBook. You can beg, borrow, or steal that. You can, try it out for a week and get all the data that you need. Often rounds are lowered because PitchBook's mainly American companies by about 30% for the Australian context. You can also look at really specific companies. If you look at Crunchbase, which is a free platform, you can see what similar companies have raised at every stage. Again, you can maybe discount that by 30% for the Australian market and maybe assume that, every amount that they raise is 25% of the post-money valuation. So it gives you an idea of, where those companies are sitting for those stages. You can also do a comparable for public companies if you wish to, although I find that a little bit better for perhaps, when you're working out what the possible exit could be as a multiple on revenue of where the company sees itself in the future. So again, look at like companies, look at a few of them and divide the market cap by the revenue. And you can also look at a specific company pre-IPO. So look at what their pre-IPO price was divided by the revenue to get sort of a multiple of revenue. But again, that's only helpful if there's a bit of revenue in the company and they've been going for a while. So the complex way actually takes into account the comparables way, but does a real analysis. So the things you're going to need are a 5-year P&L forecast, a forward-looking cap table, and cohort sales, as I've just shown you, of sales multiples or enterprise valuation from public market data. So the first place to do is look at the revenue projections over the next 5 years, get familiar with the P&L. Does it all make sense? And where do they end up in year 5, which is usually the sales year, and look at that revenue. Then what you might want to do for sensitivity analysis is reduce that by, say, 25% and then 40%, do some numbers around that revenue. And when you put together the multiple on sales, so this is when I go to those comparables and I think, how much could I sell this business for? You know, what's the public data? What are private company sales that I know about? What can I guess about others? I apply that to the revenue. And then what I do is I look at the cap table and how much investment we at Uniseed are going to give over time and what that means at the end of the day in terms of equity. And again, good founders, I think, will provide you with a forward-looking cap table. I think it's one of the key sales documents to doing a deal. Then when you've got all of that data, basically you just multiply your revenue assumptions in the sales year by the revenue multiple by the percentage equity that your fund or you will have at the end to give you your dollar return. Some people look at the internal rate of the return. That's not so relevant for our fund. So we aim to get 10 times our money back. So here's a really good example for you just to work it through. So here's 2022. You've got your pre-money, an investment of 800,000, and I like working in dollars here to give you a post-money valuation of 4.6 because we started off with a 3.8 pre-money. Then for the next round, I'm going to assume a multiplier of 1.5. So I multiply all of my post-money valuations here by each investor by 1.5, and I get a pre-money of 6.9, then an investment of 3 million to give me a post-money valuation of 9.9. So assuming Uniseed are the seed investors here, I go from 10.9% to 17.7% because we invest another million in that second round equity left at the end of it. Then I work out different multiples of sales, 2 to 5. You know, you can go a lot higher than that depending on how much growth there is. You know, segments like agriculture have really high revenue multiples on quite low revenues. That calculates to the sales revenue because my exit revenue was 22 million up here. So timesing that by the multiples, I get these. Here's my equity based on 17.7% expressed as dollars. I invested $1.5 million. This gives me, the dollar return and then the multiple here. So you can see that at a 4 and 5 times multiple, which should be doable in this case, I'm getting a 10 times plus my revenue multiple, which is where I want to be. I think it's always good to do it for the founders and perhaps even other investors as well to make sure there's something in it for everyone, right? And sometimes I take founders through this as well to explain my point of view in terms of evaluation, you know, why I can't make money or why everyone wins. I think it's really helpful. Some industries, for example, medical devices, have really specific valuation rises between rounds based on, you know, regulatory approval, you know, the technology, where it's up to, what they might have done in market with key opinion leaders, all of those things. So initial rounds, for example, are usually $5 to $8 million post-money, depending on the total addressable market. And then when they get FDA approval, the rounds end up somewhere between 20 and 30 million post money. So it's good to sort of keep the industry segment in mind as well when you do these types of forward cap tables. So then there's the club way. So most angel groups have bands of valuations that they want companies to look at. And that's just based on their experience of sales and what future rounds will look like and what dilution will look like based on that sort of cap table I just showed you. There's some really good angel groups out there, and more seem to be appearing all the time, which is terrific for the segment. We need more seed money in Australia. So, you know, there's Sydney, Melbourne and Brisbane Angels. Innovation Bay are the ones that I've had the most to do with. I also asked a famous angel investor, Rain Ong, if you ever get a chance to hear him or, you know, read his blog on Medium, it's well worth a while. And back in 2016, he saw most valuations falling into these three buckets. I think they're fairly similar now. I mean, there's a bit more market pressure now for an upward movement in these prices, but basically, you know, he's calculating for 20% equity in each round. So there we go. So a lot of angel groups use scorecards as well. I really like this one that I found online. You can find it here, again, on Medium. There's a lot of great articles on Medium on valuations. And here, you know, they apply 500,000 or up to 500,000 for each of these things: sound idea, prototype, high quality management team, strategic relationships, product rollout or sales mode. So, you know, that would lead to a $2.5 million post-money valuation if all of these things were 100%. So this is where it gets a little bit more qualitative than quantitative. And obviously some businesses can get more if the quality of them is really good. And then these are the final ways that I see being used around the trap. So there's the VC way, which is discounting revenue. So again, you know, people use a combination of these methods to come up to a valuation they feel comfortable with. Again, you just, you know, perhaps look at your public companies where they're sitting out in revenue. You discount that exit value over 5 years by using a discount rate of 30 to 50%. Obviously, you know, the outcome is highly sensitive to that discount rate. So, for example, if your sale goal was 100 million in 5 years and you're using a 30% discount rate, which seems to be the industry norm, then you just divide 100 million by 1.3 to the power of 5, which gives you a post-money valuation of 27 million. So if they're raising 8, the pre-money would be 19 million. And then some people still use this. I don't see it very often, but what would be the price if the investor just worked this up from scratch and 2 years later ended up with the product that is being pitched to you now? It's got to include all the all-in cost, you know, regulatory, patent costs if they do it, staff costs, acquisition costs of customers. You can do that. And then finally, it's always good to see the previous round anyway and see what they're raising now and have they kicked the goals that they said they would last time. You know, when you meet with companies over time, it's always really good to see if they deliver on what they say they're going to do. It's a good tell. So that's it for me today. I hope I didn't run through it too quickly, but I'd really like to give my thanks again to Wholesale Investor for having me along today, and all the people who've helped me in the last 4 years with valuations. That's Peter Devine, my boss, Jeff Waring, our wise professor at Stoic Venture Capital, who was our co-investment fund, Tamara Mills, who represents a few different family offices, Lisa Fedorenko from Albert's family office, Zach Zavos from Shearwater Capital, Alicia McDonald from Airtree, and Sam Wong from Blackbird. These guys are always there to answer my questions, and I'm really grateful for that help. And I'm sure you'll find it too if you ask for help around the traps. A quick word about my podcast coming up on research commercialisation, along with Rom Burave from Macquarie University, and also our wonderful intern at Uniseed, Alejandra Romero, where we're putting it out and we're asking people why it seems to be so hard here and overseas to get great research out of our universities and into the world. Quite topical now. So again, thank you. Don't hesitate to reach out with any questions, and good luck with your future valuations.